Welcome to Breaking News to Trading Moves. Today we're looking at, well, where artificial intelligence meets intellectual property law. It's a pretty active area right now.
It really is. The core of it is the data used to train these powerful AI models. Huge amounts of data. And the big question is, did the companies building these models actually pay for the material they used?
Right. We're digging into some recent developments, specifically a major new lawsuit aimed at Apple. And we want to explore how these legal actions might be sorting out potential market winners from, well, companies facing some serious challenges.
Exactly. It's about understanding the potential financial fallout and the opportunities being created.
So let's start with the headline. Apple's being sued over the training data for its new Apple Intelligence system. The claim comes from authors who allege Apple used pirated books, specifically from these things called shadow libraries.
And this isn't just some isolated incident. It really taps into a much broader trend. We saw Anthropic reach a settlement earlier, reportedly around $1.5 billion over similar kinds of claims.
$1.5 billion. That certainly puts a potential number on this kind of risk, doesn't it?
It absolutely does. It signals that the era of just grabbing data for free might be ending, and the costs for ensuring compliance are starting to mount up.
Okay, let's get into the specifics of this Apple case then. It was filed in California, right, as a proposed class action.
That's right. And interestingly, the lead plaintiffs are two neuroscientists.
Neuroscientists, huh?
Yeah, their specific background is noted, but the key allegation is the use of these shadow libraries.
Okay, maybe explain shadow libraries a bit more. What exactly are we talking about?
Well, think of them as vast, unauthorized online collections. We're talking millions of pirated books, academic papers, articles, basically huge digital archives of copyrighted works, all accessible without permission or payment.
And the lawsuit claims Apple used this material to train Apple Intelligence.
Precisely. That's the core allegation, that this unauthorized content was fed into the algorithms.
Now, you hear shadow libraries, you think piracy, obviously, but why would major companies even risk using data like this? What was the pull?
It really comes down to, well, three main things: scale, speed, and cost. Simple as that.
Scale, speed, cost. Okay.
To build a top-tier large language model, you need an unbelievable amount of data. Petabytes. Billions, trillions of words or tokens. Shadow libraries offer this huge scale and diversity of content instantly, and crucially, at basically zero cost.
So they could get the data fast without paying millions in licensing fees.
Exactly. It let them accelerate training timelines massively, bypassing the whole slow, expensive process of negotiating rights for every piece of content.
It was a way to get ahead quickly, even with the legal risk hanging over it.
You could say that. The competitive pressure was immense. Accessing that scale of data was almost irresistible, even knowing the potential legal trouble down the road.
Got it. And you mentioned this Apple suit isn't alone. It's part of a bigger picture.
Oh, absolutely. It's building on a legal framework that's been developing over the last few years. The complaint itself actually references other authored lawsuits against AI companies. It makes it clear this is a known issue.
And that Anthropic settlement you mentioned, the $1.5 billion one.
Yes, bringing that up is key. The plaintiffs explicitly mention it. It serves to demonstrate the potential financial scale we're talking about here. It tells the court and investors, look, multi-billion-dollar outcomes are on the table.
So it forces everyone to factor in a potentially massive liability.
Definitely. And then there's the market timing aspect the lawsuit brings up.
Ah, yes. Apple's market cap surged right after they announced Apple Intelligence.
Right. The plaintiffs are drawing a direct line, arguing that this jump in value came from using their work without permission or payment.
That's a powerful narrative in court, I imagine.
It is. It frames the whole thing as these tech giants leveraging a massive, unpriced resource intellectual property. And now the owners of that IP want compensation and maybe damages too. We're really seeing a shift in the market's focus. It used to be about data abundance, just having the most data. Now it's moving towards data compliance.
And compliance, it seems, doesn't come cheap.
Not at all. It has a steep price tag.
Okay, let's unpack that cost. How does this litigation risk really impact the big platform leaders, the Apples, the Googles of the world? Why should the market worry?
Well, the financial risk hits them in a few ways. First, you've got this ongoing litigation just hanging over them. That creates uncertainty. And investors, well, they don't like uncertainty, especially the kind of tail risk that comes with potentially huge settlements or judgments that could even force them to, say, delete and retrain their core AI models.
Right. That uncertainty can definitely weigh on their stock price, their valuation multiples.
It absolutely can compress those multiples. Investors just aren't willing to pay the same premium for growth when there's this kind of unresolved risk lurking.
Okay, that's one thing. What else?
Second, these legal fights can actually slow down innovation, or at least deployment.
How so?
Well, if you're Apple and you're facing a suit questioning the very data your new AI system is built on, you might hesitate, right? You might pause or delay rolling out major new features like a mobile AI assistant while you do internal audits, maybe try to clean up the data, filter things out.
And those delays mean lost revenue opportunities.
Exactly. It pushes back monetization, messes with earnings forecasts.
Okay, valuation pressure, deployment delays. What's the third avenue?
Costs. Specifically, the future cost of content licensing. This is probably the biggest long-term impact.
You mean even if they avoid massive fines?
Yes. If the courts ultimately rule that you can't just claim fair use for training commercial AI on this scale, these companies will have to start paying for explicit, audited licenses for the data they use going forward.
And that's a new ongoing expense.
A massive one. It fundamentally increases their cost of goods. Sold the QGS for every single AI feature they offer. It becomes a permanent drag on margins.
Okay. So it seems like a lot of potential negatives for the platform builders. But there's always another side to the coin, right?
Yeah.
What about the upside? Who benefits here?
Ah, yes. This whole situation creates a significant opportunity for content owners.
The ones whose data might have been used without permission.
Precisely. For years, publishers, news organizations, artists, they struggled to get properly paid for their digital content as tech companies scraped and indexed everything. Now, with these huge potential legal liabilities hanging over the AI platforms, the tables have turned, you could say. The data owners suddenly have real negotiating leverage.
Leverage to demand payment.
And potentially substantial payment. If the legal and regulatory environment moves towards requiring explicit auditable licenses for training data, which seems likely, then the AI companies have to come to the table.
So corporate budgets that might have relied on free scraped data now need to be reallocated to pay for licensed, verified content.
That's the core idea. It's potentially a huge transfer of value from the AI platform builders back to the creators and owners of the intellectual property. They could be looking at entirely new, substantial revenue streams.
Okay, that makes sense. A shift in who holds the power, driven by legal necessity.
So let's break down who these beneficiaries might be. If clean licensed data becomes the standard, who's really set to gain? We can probably group them into three categories.
Okay, three groups. What's the first one?
The first, and maybe most obvious, are the rights-holding publishers and news data owners themselves.
These are the companies that own large archives of original content.
Exactly. Their advantage is suddenly having much stronger bargaining power to strike paid licensing deals. They can turn their existing content libraries into high-value data feeds for AI training.
And who are we talking about here? Specific companies?
Some key names would be the New York Times, that's tickers NYT, News Corp, ticker NWSA, RELX, and Thomson Reuters, TRI.
Okay, NYT, NWSA, RELX, TRI. Why them specifically? What makes their text data more valuable in this context than, say, just scraping websites?
It boils down to legal assurance and data structure. These big organizations own vast catalogs, yes, but crucially, they have verifiable and clean rights chains. When they license their data, they can essentially guarantee its provenance and offer legal indemnity. That's huge for an AI company trying to avoid lawsuits.
They're selling peace of mind, basically.
Pretty much, especially for training models on quality journalism, analysis, long-form content, the stuff NYT and NWSA specialize in, plus the type of content matters. For AI to generate reliable, factual output, especially in specific fields, it needs high-quality inputs.
Like legal or financial data?
Exactly. Think about Thomson Reuters, TRI, with its legal information, or RELX with its academic journals and legal databases. That kind of specialized, often timestamped data isn't easily replaceable with general web content.
So it becomes a must-have for certain AI applications.
Right. If using potentially pirated data is a liability, paying RELX or TRI for guaranteed clean, specialized data becomes a necessity, not an option. That gives them significant pricing power.
Okay, so publishers and news data owners are group one. What's the second category of winners?
The second group is the licensed content marketplaces.
Ah, platforms that already act as intermediaries for rights-cleared content.
Yes, their advantage is offering ready-made datasets that are already legally compliant and often structured in a way that's easy for AI systems to ingest.
Which companies fit here?
Think Shutterstock, ticker SSTK, and Getty Images, ticker GETY.
SSTK and GETY. Now, the Apple suit is about text, but these guys are mostly known for images, video, music. How does the text issue benefit them?
It's less about the specific type of content and more about their underlying business model and infrastructure. These companies are experts in managing rights clearance at scale. They already run platforms selling licenses for millions of images, videos, etc. And importantly, many already have large-scale licensing deals specifically for AI training in place.
So they have the systems ready to go.
Exactly. They know how to track usage, manage permissions, ensure compliance across vast libraries. If stricter data rules become the norm for all types of content, text, image, audio companies needing compliant data will naturally turn to these established players.
They offer a way to bypass the headache of auditing potentially problematic scraped data.
Right. It's about reducing legal friction. Plus, think about the future. AI systems will need sophisticated tools to track how licensed content is used in queries and outputs. These marketplaces often have that kind of granular tracking infrastructure already built. They become essential partners.
Okay, selling certainty and compliance infrastructure. Makes sense. What's a third group?
The third group is IP and research data platforms. These are a bit more specialized.
How so?
They focus on providing essential compliance tools, yes, but also premium, highly specific data sets often needed for research or regulated industries. There's some overlap with the first group, but the focus is more on data for utility and compliance rather than just general foundational model training.
And who falls into this category?
CLVT, ticker CLVT, is a key one, and RELX shows up again here.
RELX in two categories.
Yes, it highlights their unique position. They own valuable content, and they provide the platforms and tools needed to use data compliantly, especially in fields like science, law, and patents.
And why is demand for platforms like Clarivate, CLVT increasing now?
It's partly due to the rise of more sophisticated AI techniques like retrieval augmented generation or RAG.
Okay, RAG. Remind us quickly what that is.
Sure, RAG systems try to make AI outputs more accurate and less prone to making things up hallucinating. They do this by having the AI retrieve information from a specific, trusted external knowledge base before generating an answer. So instead of just relying on its general training data, it pulls real-time verified info.
So if you ask an AI copilot about, say, patent law, the RG system would pull data directly from a licensed patent database.
Exactly. And that drives demand for these curated, legally sound datasets, patents from CLVT, legal rulings, academic papers from RELX. The source needs to be impeccable, especially in regulated industries. You need that clear audit trail.
The provenance of the data is critical.
Absolutely critical.
Yeah.
And these platforms often provide more than just the data. They offer the tools around it: usage analytics, permission management, audit trails. These are the very tools the big tech companies need to build internally or license to ensure they stay compliant. They're selling the infrastructure for safe AI operation.
All right, so we've covered the potential winners. The publishers, the marketplaces, the IP platforms. Now let's talk about the other side, the companies facing headwinds. Who might see increased costs or delays?
Yeah, these are the groups where the rising costs of compliance and the operational uncertainty really start to bite. It could potentially erode some of the valuation premium they've built up around AI.
And the first group here is probably the most obvious one.
Right. The big tech AI platforms themselves.
The ones actually building and deploying the large foundational models.
Exactly. We're talking about Apple, ticker AAPL is the latest example, but also Microsoft, MSFFT, Meta Platforms, META, and Alphabet, GOOGL.
AAPL, MSFT, META, GOOGL. What's the main worry for them beyond just the potential settlement costs?
It's the ongoing upward pressure on their operating expenses from content licensing. If more and more content requires explicit payment, that's a structural cost increase. But maybe more concerning is the risk of legal mandates forcing them to take drastic actions, like having to implement really aggressive filters on their existing models, which could seriously hurt performance. Or, worst case, being forced to do a full model retraining.
Retraining an entire foundational model. How big a deal is that?
It's a huge deal. We're talking potentially billions of dollars in compute costs and engineering time. And it could take months, maybe even a year, depending on the model size. It's not like pushing a software update. It's rebuilding the core knowledge.
Wow. Okay, so billions in costs plus massive delays.
Right. Any mandate like that essentially stops product development in its tracks for a significant period.
And that uncertainty, those potential delays, hit investor confidence and valuations.
Definitely. The market is generally priced in pretty smooth, rapid AI rollouts. Litigation like this throws a major wrench in those timelines, slowing down new features, delaying monetization, and creating uncertainty around future earnings.
Okay, so the big platforms are clearly exposed. Who's next?
Next are the companies we could call model training heavy spenders and integrators.
These aren't building the base models, but they use AI extensively in their own products.
Exactly. They might be building specific applications on top of foundational models or integrating AI deeply into their existing platforms. They face rising costs for the AI components they rely on.
Can you give examples?
Think about companies like Salesforce, ticker CRM, or Snowflake, SNOW.
CRM and SNOW. How does the risk hit a data cloud company like Snowflake?
It's essentially a pass-through cost, but it impacts their model. If their suppliers, the big AI platform companies, face higher licensing costs and pass those on, then integrators like Salesforce or data platforms like Snowflake see their own costs rise. The expense of acquiring the necessary data or accessing the AI APIs goes up, and that directly feeds into the cost of their own AI-powered features, like Salesforce's Einstein or Snowflake's AI tools. It compresses their margins.
So if Microsoft has to pay more for data for its Copilot, Salesforce might have to charge more or make less on its AI features built using similar tech.
That's the basic mechanism. And there's another potential impact: longer sales cycles.
Why is that?
Enterprise customers are becoming much more aware of data provenance, compliance, and cost volatility around AI. If the underlying AI components become more expensive or legally complex, customers might take longer to evaluate and adopt these AI-driven solutions from companies like CRM or SNOW. That can delay revenue.
Makes sense. Compliance concerns slowing down adoption. Okay, who's the third group facing headwinds?
The third group is the AI compute beneficiaries.
Ah, the companies selling the hardware. The picks and shovels for the AI gold rush.
Exactly. Primarily NVIDIA, ticker NVDEA, and AMD, AMD.
NVDA and AMD. Now, surely their long-term growth isn't really threatened by these data lawsuits, is it? Isn't the demand for AI chips still massive?
You're right. The long-term demand picture likely remains very strong. The risk here is more about the near term. It's about potential wobbles in demand if AI development slows down, even temporarily.
How could these lawsuits cause a slowdown big enough to affect chip demand?
Well, think about it. Even relatively minor delays caused by companies needing to pause training runs to audit their data or filter it or secure new licenses. Those pauses mean the expensive GPUs they've bought might sit idle for a bit longer than planned.
Okay, so deferred training runs.
Right. And if a major platform decides they need to pause a big training run for, say, 6 or 8 weeks to sort out data issues, they might push back their next hardware order. They don't need the next batch of GPUs until the current ones are fully utilized again.
Got it. So it could create bumps in the ordering patterns.
Exactly. It could create pressure on near-term sentiment about AI infrastructure spending. Given the incredibly high expectations baked into stocks like NVDA, even a hint of a slowdown or pushed-out orders can cause outsized volatility in the stock price.
So less a fundamental threat, more a risk of near-term volatility and sentiment shifts.
That's a good way to put it, at least based on what we know now.
Okay, so we've mapped out the potential winners and losers based on this evolving legal landscape. How should people be thinking about this from a trading or investment perspective? What should we be watching closely in the near term?
Well, keeping an eye on the legal proceedings themselves is key. Watch for any new plaintiffs joining the class actions or significant procedural milestones like rulings on motions to dismiss. These can create headline risk.
And anything specific within the legal process?
Discovery could be important. If the process uncovers specific, concrete evidence of unauthorized data use that's directly linked to AI products already out in the market, especially on mobile devices, that could be a major development.
And presumably, everyone will be watching Apple's response very closely.
Oh, absolutely. Any official comments from Apple during earnings calls, product launches, anywhere really, about how they're handling licensing or sourcing their data, that could set a benchmark for the whole industry. Their strategy will be scrutinized.
Okay, that's the near term. What about medium-term catalysts? What events might really confirm or change the market's current direction on this?
On the positive side, For the data owners, the publishers, the marketplace's a big catalyst would be the announcement of a major new licensing deal. A large AI company publicly agreeing to pay significant fees for content would really validate this whole thesis.
It proves the revenue stream is real.
Exactly. And on the negative side for the platforms, adverse court orders would be key.
Like what specifically?
Something like a court ordering a company to conduct a full, independent audit of its training dataset, or requiring them to implement really robust, technically difficult opt-out mechanisms for rights holders. That kind of ruling signals the compliance burden is becoming truly substantial and costly.
Given all this potential for news and legal shifts, what's a key risk management takeaway?
I think the main thing is to be prepared for volatility driven by headlines. These legal developments can often seem to come out of the blue, so one tactic to consider might be reducing overall exposure slightly around key court dates or major AI product announcements from the companies involved, just to mitigate the risk of getting caught on the wrong side of a sudden gap in prices.
Okay, manage exposure around potential news events. Now, you mentioned sorting winners and losers. Is there a specific pair trade idea that captures this dynamic?
Yes, there's a potential pair trade strategy that directly plays this theme. If you believe the legal pressure on platforms will intensify, forcing higher compliance costs, you could consider being long the perceived licensing winners, maybe a basket including Shutterstock, SSTK, or the New York Times, NYT, and simultaneously short a basket of the AI platforms facing the most direct risk, perhaps Apple, AAPL, and Meta, META.
So long the beneficiaries, short the ones facing headwinds, betting on that divergence.
Precisely. It aims to capture the relative performance difference driven by this specific legal and regulatory trend while potentially hedging out some broader market moves.
And what if things resolve differently? What if there's a big settlement that's seen as favorable to the platforms, or maybe even legislation that clarifies things in their favor?
Well, in that scenario, you potentially flip the trade. If the legal risk seems to dissipate quickly and decisively for the platforms, you might go long the platform basket, AEPL, META, and short the licensing beneficiaries, SSTK and YT, betting that their newfound pricing power was temporary.
Interesting. So the trade really hinges on how this legal battle plays out. It seems like the core theme today is that getting the intellectual property side right, ensuring data is clean and properly licensed, is becoming, well, just the cost of doing business now in AI. It's not optional anymore.
That really sums it up. IP clarity and compliance are moving from an afterthought to a foundational requirement. The market is adjusting to that reality, rewarding those who own or provide the clean, auditable data assets needed for this new era. And of course, we must clearly state that this is not financial advice or buy or sell recommendations. This conversation is purely based on the opinion of the author of the material we discussed.